as financial statements of group entities. Now, this standard is not one single standard, it's a combination of multiple standards combined together, where we discuss about Ind AS 27, 28, 110, 111, and also a certain disclosures under 112. Now, all five standards put together are being combined and discussed as a part of this financial statements of group companies or regarding consolidated financial statements. Remember, we also take a part of Ind AS 103 as a discussion point under these standards. Guys, though 103 will be dealt as a separate standard, we will try to apply even a part of 103 into this particular standard. Now, what does this standard actually talk about and how was it dealt earlier under accounting standards is something we need to discuss. Now guys, this consolidated financial statements has enhanced in its scope. The scope is much more vast after the Companies Act has come in. Because the Companies Act 2013 has introduced new sections like 129.3 and 129.4, which has made sure that consolidation is applicable for any company whichever is registered under Companies Act 2013 or the earlier Companies Act. So that is the reason why this standard becomes important. The earlier standard did not really mention what are the companies which are supposed to present consolidated financial statements, but earlier the consolidation was as per SEBI listing agreement. So I'm just telling you how it has changed. Earlier and now. Earlier, my consolidated financial statements was supposed to be presented for consolidation is required by SEBI listing arrangement. Or listing agreement. That means I am talking about only enterprises whose debt or equity securities have been listed. Where debt or equity securities are listed. When I come to the current scenario, consolidation is as per the Companies Act. Consolidation is required by any company having one or more subsidiaries. This has been introduced because of the amendment in Companies Act 2013, where we have section 129(3) and 4 of Companies Act 2013. So that means the scope of the standard has now become much more vast than what it was before. Earlier, only companies which were listed. Now you tell me, out of the total number of companies in this country, what is the percentage of companies which get listed? Not even 0.1%. So that means the balance 99.9% of the companies who are never listing their equity and debt securities were exempted from presentation of consolidated financial statements. However, now because of the change or amendment in Companies Act 2013, all such 99.9% of the companies also have come into the ambit of this consolidated financial statements. Now earlier, I was following 3 standards to present consolidated financial statements. One was AS 21, 23, and 27. The 21 was talking about consolidation with subsidiary, 23 was talking about associate, 27 was talking about joint ventures. Now we will start discussing about 5 standards which deal with consolidation. Ind AS 21, separate financial statements. 28, accounting for investments in associates and joint ventures. 110, consolidation with subsidiary. 111, joint arrangements. And 112, disclosures regarding interest in other entities. So we have a complete revival of the entire accounting standards applicable for presentation of your financial statements on consolidated basis. So I am talking about AS 21, 23, 27. These were the earlier applicable standards, where 21 we were talking about consolidation with a subsidiary, accounting for investment in associates in consolidated financial statements, accounting for investment of interest in joint ventures, in consolidated financial statements under AS 27. These were the 3 set of standards which were applicable under the earlier regime under accounting standards. But now, as Ind AS was adopted starting from 2015, we have 5 different standards which are applicable for presentation of financial statements on a consolidated basis. What are these Ind AS? Ind AS 27, which deals with separate financial statements. Then we have Ind AS 28, which deals with accounting for investment in associates and joint ventures. Investment in associates and joint ventures. Then we have a discussion about the most important standard under Ind AS, that is 110, consolidation with subsidiary, consolidated financial statements. Our major discussion on this topic will revolve around 110. Consolidated financial statements. Then we have Ind AS 111, which deals with joint arrangements. Finally, 112, which is a disclosure standard, disclosure of interest in other entities. One two. Disclosure of interest in other entities. These are the set of 5 standards which are applicable as far as consolidated financial statements is concerned. Now guys, I will start my discussion only to deal with subsidiary. So first we will talk about subsidiary, then we will definitely go into joint arrangements, associates and joint ventures. But first our concept will be to discuss about what is your consolidated financial statements involving one or more subsidiaries. First, we'll deal with one subsidiary, then we will combine more than one subsidiary and try to present our consolidated set of financial statements. Now, when do you call something as a subsidiary? I will call an entity as a subsidiary of the parent enterprise if I have a control over the other enterprise. I will call X as a parent enterprise and I'll call Y as the subsidiary of the parent enterprise if X has a control over the other enterprise. Now we come to the discussion around this word control. What do you mean by control? How do you extract control over other enterprise? Now, for me to demonstrate control over other enterprise, I have two sets of definition which will come up. One set of definition which is as per the Ind AS, one set of definition which goes as per your Companies Act. Both are slightly different, but in logical sense will still mean the same. Let's look at the definition. Definition of control. Guys, I'm just giving one more name to it. Parent can be called as investor. Subsidiary can be called as investee. Okay. These words I will use it when I'm talking about definition of control. That's the reason why I've taken them. One definition is as per the Ind AS. The other control definition is as per Companies Act. Now, under Companies Act, a particular section which discusses about control or definition of control is section 227. Of Companies Act. But as per Ind AS, I am going to discuss the definition of control as per Ind AS 110. Let's look at the definition then. According to your Ind AS 110, the control definition goes like this, where the investor has a power over the investee, power over investee. First point. Second one, is exposed to variable returns from investee. Is exposed to variable returns from the investee. What is variable returns? That means there is no fixed rate of interest, but this is a dividend income which I am talking about. Particularly, I am talking about dividend income. That is variable. Third one, ability to use power. You said he has a power over the investee. He should also have an ability to use its power, ability to use its power to effect the investor returns. You said that he has a power over the investee and is exposed to a variable return. Such power should be used to influence or to affect the variable returns which I derive from the investee, and then in such situation I can say that there is a control as per Ind AS 110. Three essential points which together have to be satisfied. I have a power over the investee, I am exposed to variable returns from the investee, I have an ability to use the power to affect the investor returns which I derive from the investee. Now, let's look at the control definition as per Companies Act 2013. This is very similar to what we had even under AS 21 as well. The earlier standard also had the similar definition of control. Let's look at the control definition here. Right to appoint majority of board of directors or second one as a control over management and policy decisions by virtue of shareholding, by virtue of shareholding. When do you say that you have a control due to shareholding? If I hold more than 50% of the entity's shares, then I am said to have a control. Greater than 50% of voting power, then I am said to have a control over the management. A right to appoint majority of the directors also might be due to shareholding of more than 50%, or sometimes could be even as per a shareholding arrangement. A shareholding arrangement gives me a right to appoint majority of the directors even though I don't hold more than 50%. That also can give me a right. So right to appoint majority of board of directors can either arise due to shareholding or could arise due to shareholders arrangement. But control over the management and policy decisions by virtue of shareholding should only arise when an enterprise controls at least 50% of the voting power in another entity. Remember, one very critical difference is all these points are supposed to be satisfied to demonstrate control under the Ind AS. But when I'm talking about the accounting standard AS 21 or regarding the Companies Act 2013, yes guys, so let's look at accounting for a subsidiary. Accounting for subsidiary. Here I'll bring in the concept of this Companies Act 2013 section 129.3 and 129.4. Let's look at what each section talks about. Section 129.3 of Companies Act, what does it discusses about? Section 129.3 says that where a company has one or more subsidiaries then it shall present financial statements on consolidated basis. Which will be laid in an AGM annual general meeting every year, apart from the financial statements prepared as per 129.2. Guys, 129.2 is standalone financial statements or separate financial statements. So apart from those standalone financial statements, an entity which has one or more subsidiaries shall present its financial statements on consolidated basis to be presented or laid in the AGM. This is section 129.3, where it is required to present a consolidated financial statement. Similarly, we get a 129.4, the immediate next standard, which talks about the form and content of consolidated financial statements. Here he goes on to say, the provisions of Act applicable to presentation, adoption, and audit presentation, adoption, and audit of financial statements under section 129.2, that is nothing but your separate financial statements, shall apply mutatis mutandis, that means as it is, legal term guys, as it is to the consolidated financial statements. So there were two sections of Companies Act which become relevant for accounting for a subsidiary, which we just discussed. The first part was 129.3, which is requiring a company which has one or more subsidiaries to present financial statements on consolidated basis along with his separate financial statements presented as per 129.2. 129.4 comes out to talk about their presentation, adoption, and audit of consolidated financial statements will be as it is, as you have presented it for financial statements which are presented on a separate or standalone basis under 129.2. These are the two important sections of Companies Act which will bring out the concept or which will highlight the concept of consolidation in Companies Act. Now, as we discuss about this, saying that every company is supposed to present financial statements on consolidated basis, at the same time, there are certain exemptions also which are given. What are the enterprises which are exempted from presenting consolidated set of financial statements? exemption from consolidation. What exemption do you get from consolidation, and what enterprises are actually eligible for this exemption? Very simple, guys. I'll talk about two exemptions. The first exemption which I'm talking about is very simple. If I have an entity X and entity Y, and in a situation where X controls Y, genuinely a common situation where you say X is the parent and Y is my subsidiary. But if Y also controls another entity Z, then in such situation, X is called as the ultimate parent, Y is called as intermediary parent, and Z is called as my subsidiary. Remember, guys, X also has an indirect control over Z. This is not called as direct control. This is indirect control. That means X can control Y, Y can control Z. So there is an indirect control of X on Z. Now, in this kind of situation, the exemption is applicable only for the enterprise Y. Entity Y is eligible for exemption from consolidation. Why is it eligible for exemption, and under what situation is Y exempted from consolidation? Shall I put it like this in very simple sense? If consolidation is already provided by X and such consolidated financial statements of X are available to the user, who is when X consolidates with both Y and Z, why should again Y consolidate with Z? There's no particular point of Y consolidating with Z. This is particularly what the exemption relates to. The intermediary parent is exempted from consolidation if the ultimate parent enterprise is presenting financial statements on consolidated basis. Clear? Let's look at it. I'll explain this exemption, guys. First point for this: if the parent is a subsidiary of another enterprise, here Y is a subsidiary of X, subsidiary of another enterprise. Number two, the equity or debt instruments of the parent are not traded in a public market Guys, these markets, I'm not limiting myself to NSCs and BSCs, guys, because my logic of public markets are either national or international markets. So may not be with SEBI, but could be with any other securities exchange. The equity instrument or a debt instrument are not traded in public markets. Number 3. The parent is not in process of listing. Or filing its financials with Securities Commission. In India, the Securities Commission is SEBI. Outside India could be any other similar organization or similar regulatory body. For the purpose of listing any class of instruments, could be equity securities or could be debt securities, no class of instrument are in the process of filing or in the process of application. Last and the most important point, ultimate parent provides financials on consolidated basis. Provides financials on consolidated basis. 4 important points which I listed out. First one, I said your parent enterprise is a subsidiary of another enterprise. In this given example, Y is the parent, which is a subsidiary of another enterprise, X. Correct? Second one, equity or debt instrument of a parent are not traded in markets. The parent is not in the process of filing its financial statements. Ultimate parent is providing financial statements on consolidated basis. If all 4 points are basically satisfied, you can apply for an exemption from consolidation.